Well, with that, we're at the top of the hour here. So maybe we should kick this off to all listening. Welcome. Derek Keacho, Kevin O'Laughlin, and myself here, our wealth strategy team internally. We work together at Cahill Financial Advisors, and we are here talking about what's being called Secure 2.0. So major tax provision that came in December, $1.7 trillion tax bill. Tell you right up front, we are not going to cover it all. We're hitting a few high points that we think are most applicable to our clients. I think there's over 90 new provisions, and I don't know, either of you guys remember how many pages exactly were in the bill?
4,100, I think.
Yeah,
It was
sounds
in
right.
the thousands. Yeah,
We should be able to get everybody out of here in 6 or 7 hours with no bathroom breaks.
Yeah, I think it was. I think you're right. I seem to remember there's over 4,000 pages. So we have talked internally. We've gone over a few things and said what really is applicable to our clients. What are the most important things that we want to highlight? We're still sifting through a lot of this ourselves and thinking about what's new, what's different, what is a big deal, what maybe isn't as big of a deal. There's a lot. And I guess what I'd say is there's quite a few things we look and say, that's kind of interesting, but it doesn't, it's not significant. It doesn't apply to many people. It doesn't move the needle. But there are some big points in there. So, maybe I'll throw in up front our standard disclosure. We are having a general discussion here. Please don't take any of this as specific advice. Give us a call at the office to talk about how this really applies to your specific situation, whether you're watching this webinar live or listening on podcast or YouTube or wherever it may be. Consult your own tax experts, do your own research, or like I say, give us a call. And we're going to just try and provide a fairly concise overview of some things that we think are fairly important topics for a lot of the types of people that we're working with. So the bill is called Securing a Strong Retirement 2022. They're calling it Secure 2.0. The original Secure in 2019 was actually setting every community up for retirement. And that came out a couple of years ago. There were not nearly as many provisions, but there were a few key ones that we've been spending a lot of time talking with people about. Probably some of the big ones were bumping the required minimum distribution age out. That was real key. I think we're going to talk about the next push on that's happened. But Kevin, I think our entire career was age 70 and 1/2, and that half added a lot of confusion. And are you 70 and a half? And is it that year? Is it the year you turn 70 and a half? And so they simplified it and made it age 72. That's really nice. And now there's a plan to push that out even further. So that's certainly interesting and impacts a lot of planning. I think one of the other big ones that we've spent a lot of time looking at for clients and still warrants attention, this 10-year payout of retirement plan assets, tax deferred assets, whereas before you had the ability to do a stretch IRA or inherited stretch, 401k rolled into an IRA. And this was something that was talked about for years and years and years, probably decades. I remember in the early 2000s at a large client event, giving a big breakdown on cascading IRAs and how to do that. So that's changed. Money has to come out within 10 years. And there's still, it seems, a bit of uncertainty of, is it within 10 years? Is it equally over 10 years? So some of these things, and there's a few points in the Secure 2.0 where it's not entirely clear. So we're going to focus on the new issues and what's in it for there. And like I say, I think these are things we're going to be looking at over the course of the year in individual planning meetings, and we may be breaking out more broad-based thought pieces along these lines as well, especially I think as it pertains to college savings and IRAs and some of those. So we've kind of have a few main broad themes, and the first big one is around the idea that there are provisions in here that are allowing investors to save longer for retirement, and that has to do with this RMD, required minimum distribution, being pushed out. Kevin, you have some thoughts to share with us on the changes that are in place there?
Yeah, thanks, Scott. I think the idea of additional or continued savings is one facet. The other portion is, if you've done a good job saving, and you have accumulated a significant amount of your wealth inside of these tax sheltered plans, can you continue kicking the can down the road? So perhaps you're not necessarily putting more dollars towards the plan, but if if there's a circumstance that allows you to not begin taking distributions, and then maybe even Roth conversion, et cetera, that is a big opportunity. So like you alluded to earlier on, when we started, almost 25 years ago, 70.5 was the trigger, that if you have gained the advantage of deferring income for a number of years, the IRS, Uncle Sam, ultimately wants to get paid back 70.5, which didn't make sense then. It didn't make sense until they restructured it back in late 2019, early 2020. That has changed. So 72 became the number. Now with this new act, 73 is the number. And kicking the can down the road, starting in 2033, that then becomes age 75. So it is a big change, a handful of years on tax deferral, continued tax growth. It's never perfect, and we have periods of time where markets go up and down over a 5-year period. But when we look at long-term numbers, the ability to continue that tax deferral piece can be extremely impactful over those years. But perhaps most importantly, for us and the work we do with our clients, that is a huge opportunity for decision-making around taking Social Security. For someone that may have been contributing to a deferred compensation plan, or maybe still is, what is the payout regime they're targeting? Is it a lump sum? Is it a 5-year? Is it a 10-year? But then, maybe the biggest one is, can you convert if you've retired? If you are in a low tax bracket, relatively speaking, based on your needs, if you're in a spot where required minimum distributions are eventually going to push you into a higher tax bracket, could you convert some of those dollars to a Roth? And we're going to talk a lot more about Roths, but there are a ton of tax implications that come with this new rule.
Yeah, I think that's a big one. So, most people love the idea of kicking the can down the road when it comes to the tax bill. So offhand, this sounds like a good thing. And I think in most cases, it is nice to allow that flexibility to kick the can further down the road in terms of the required distribution, having to take the taxable distribution out of your IRA or your 401k or your 403b. But I like the point you made there, Kevin. We've had so many discussions where when we're taking a longer year view, not just that point in time saying, I don't want to pay tax on these dollars now, I'm going to kick the can down the road another year. We are often trying to take a very long view, and sometimes we're identifying, hey, if someone has retired a little bit earlier or in their mid 60s, are we able to create a gap year or a couple gap years, a tax gap year, and clean the slate with a few years before Social Security, before required minimum distributions, where we can have some low tax bracket years, and like you're pointing out, may decide that we want to draw some of that income in low tax brackets, and in particular in the vein of Roth conversions. So that's very popular one, or repositioning a portfolio, or taking money out of a deferred compensation plan, or selling employer stock, or all those types of things that it might be nice to have clean slate there. And this seems to allow for that a bit more, but also something to watch out for. Like you say, if you kick the can down the road, what is it going to be? What did you say, Kevin? 10 years will be age 75. And then on the back end, there is a mandatory 10-year payout. There's the potential to build a much larger balance tax deferred, and it's going to have to come out over a shorter period of time. So interesting planning opportunity both ways, but we're not building too big of a tax tsunami here that could hit.
Well, yeah, incredible point, because that is where in many cases the nuance of personal circumstance comes into play. We've got some clients that may have several beneficiaries. Some of them may be in a power stroke of their career, high earning years, expectations to continue earning more dollars, and some may be pursuing artistic endeavors, something that may not have them in the same tax bracket as the other beneficiaries. And so, considering considering who should realize the tax and in what bracket does come into play from that longer term estate planning conversation. So
Absolutely. Right. So many points we could go off on tangents on, but a year ago we had hosted one of these wealth strategy sessions. We talked about the idea of state relocation. Now, what did we get overnight here in the Twin Cities? 8 inches, foot of snow. There's a lot of people that dream of spending some time in a warmer climate and maybe a more friendly tax climate, especially in those early retirement years. And that idea of creating that gap year or series of gap years, lower tax brackets to potentially do some proactive tax planning is very appealing. So, well, let's see. Derek, I think you had some thoughts for us on catch-up contribution limitations and maybe some changes there in Superior 2.0.
Yeah, a few changes coming everyone's way on the catch-up front, and mostly good news. For those who are unfamiliar or have forgotten, once you reach age 50, you can set aside more money in your IRAs, work-sponsored plans, kind of above and beyond the normal contribution limits. So currently, if you're age 50 and above, you can set aside an extra $1,000 into your IRA. Again, above and beyond the annual contributions, which has been the case for quite some time. However, beginning in 2024, those catch-up contributions are now going to be indexed for inflation in increments of $100. So that'll be helpful.
Mhm.
Also starting in 2025, for people who are age 60 to 63, they are going to be able to contribute a larger contribution of $10,000 or 150% of the regular catch-up contribution amount for that year, again, indexed for inflation. So that would apply to retirement vehicles such as 401k, 403bs. So I guess ultimately, why does this matter from a planning standpoint? Well, for those that don't need the income to live off of right now and want additional dollars to flow into these plans, it's good news. And it will be helpful for those maybe that feel a little bit behind with their retirement savings. So those are just a kind of a couple key pieces from the catch-up contribution limits being bumped up.
So more dollars available to go in if you have it to save. Yeah. I think one of the other big interesting themes that we saw and we've been talking about is really an endorsement of Roth treatment across the board and an expansion there. And this is an interesting one because I think we've all fielded lots of questions. This idea of the Roth IRA, remember when it came out, the idea that you are taking money that you've already paid taxes on and contributing it to an individual retirement account, and it would grow tax deferred. And as long as you met the stipulations and the rules, the gains would come out tax free. And ever since it came out, and then it's been expanded, and that type of treatment is allowed in 401ks. You could question, say, well, this seems too good to be true. Are they going to come back and decide that those accounts are taxable? And that's been a thought that's in the back of people's mind for a long time. Not necessarily trusting it because it's a big decision. I think you're potentially giving up a lot, saying, no, I don't want to take that tax deduction now. I will pay tax now and put it in the account. So this could be a good deal if you circumstances line up and it looks like you're going to be in a higher tax bracket later, but you're potentially leaving a lot on the table. And but we've seen a number of things here that I think we'll touch on, saying that in general, Congress likes Roth treatment, and it seems to be the thought, why? Why would they like this? Why are they giving up being able to tax all those gains? Because they get the tax dollars now. So it helps with the budget now and makes things look good. So there's a whole slew of things where it seems like Roth treatment is not going away. In fact, it's being encouraged, and some of these cases mandated to generate more tax revenue right now. So let's see. Yeah. I mean, this is a huge one. So, Kevin, required minimum distributions on Roth employer plans.
Yeah. So Scott, one of the pieces, and as we've done the calculus for a lot of clients, the possibility of converting a portion of their traditional IRA to a Roth has several advantages. One, it's not more ordinary income that's going to be kicked out, but then add on top of that from a beneficiary standpoint, in particular, if they have beneficiaries that are in high income earning years and relative to life expectancy and reasonable expectations that, they would likely inherit the dollars. Well, Roth is a really good legacy planning tool, but it's also had the Roth IRA, the benefit of being a tool that doesn't require required minimum distributions.
Mhm.
So that RMD piece didn't apply to the Roth IRA. It did if you had been a contributor to your employer-sponsored plan,
Mhm.
their Roth 401k, Roth 403b, et cetera, et cetera. And so what the Secure Act 2.0 has done is actually eliminated that requirement. And so whereas before it might have been a real clear layup that we're going to move those Roth 401k, we'll say 401k dollars, to your IRA, that rollover process, tax-free transfer. And the reason was we wouldn't then have to take those dollars out as RMD. Now we don't have to worry about that. The calculus, though, is there's still a lot to consider.
Mhm.
One is, what would be the investment selection within the plan? What are any extraneous costs that the plan levies upon participants, et cetera, et cetera. So, and not to say that there's a big change in what might be a default level of advice, but there is now the flexibility that if you have a strong plan, if there are reasons, maybe creditor protection, and so on, that keeping the dollars in the plan for at least a period of time makes sense. In those cases, we now have more flexibility.
Yeah, that's great. I mean, it's just kind of equalizing the treatment and
Exactly.
blanket statements. Many people like rolling their 401k into an IRA, and there can be advantages with flexibility and investment choice and more control. But sometimes they might want to keep in the plan. So this is nice that you're not weighing it saying, well, wait a minute, Roth IRA, no required minimum distributions, Roth 401k, there are. Now it's the same. So if there is a reason, and creditor protection is maybe one that you mentioned, there might be difference in your state and how those 401k dollars are treated versus IRAs. Now you don't have to worry about it on the RMD. So that's great. Derek, you were talking about catch-up provisions. There's some change there on the Roth side as well.
Yeah. So this definitely ties in nicely with what I was talking about before with kind of modifications to catch-up contributions. So starting next year in 2024, individuals who earn $145,000 or more, if you are making catch-up contributions in an employer-sponsored plan, all of those catch-up contributions have to be made on an after-tax basis, so into a Roth type account. And that is even if your contributions throughout the year are made on a pre-tax basis. So as Scott kind of alluded to earlier, essentially what is happening here is the government's pulling tax revenues forward. So, individuals who are earning higher incomes, who are choosing to make the catch-up contributions, are paying taxes in higher brackets. So if you're interested in making or continuing to make catch-up contributions and you're making $145,000 or more, you'll want to be sure that your employer does have the Roth option for you. Some plans and some employers choose not to, but this will be a requirement going forward, like I said. And then, if you are considering this or want to continue doing it, please be sure to talk to us because, we need to take into account your current situation and projected future financial situation to see if this strategy still makes sense.
Yeah, and that point you mentioned, I know that's something I kind of have a flag in the folder to follow up on. I've heard some commenters say that there can be a potential real issue if the plan does not allow Roth contributions and you have people making catch-ups. It can potentially screw up the whole plan. There's a few of these areas where it seems some of these things were written into the code and they are potentially setting up some traps mechanically. So
Yeah.
Well, one other piece related to that, we've talked about 401ks a lot, plan a lot of corporate employees are familiar with, but smaller businesses for a long time have sometimes offered simple or SEP plans, versions of IRAs that allow for retirement plan funding, simplified employee pension or savings incentive match plan for employees, SEP and simple. They now allow for Roth contributions. If that makes sense in that person's situation, that's a nice deal. There was some real funny quirks in the simple, was it no rollover within 2 years or something like that. And so it was really kind of precluding someone from being able to have Roth contributions if that was their form of employer plan. And now that's an option. So good news. I think we'll take that as good news. Even though I think, having worked through many cases, we may come maybe with a bit of a contrarian stance on the Roth treatment. The media loves to tout it and it sounds great, but I think oftentimes we're looking at, especially for high income payers, and saying, maybe it'd be better to take the tax deduction now and not use the Roth treatment. So, but we like having options, right? Put a tremendous premium on flexibility in different types of choices.
Yeah.
So, Kevin, you've been doing some work with some clients and setting up new retirement plans. We're talking about retirement plans. I know you're in the process with one right now. There's a tax credit for establishing plans, or something that was added in with Secure 2.0.
Yeah, so there's up to a $5,000 credit for establishing a new plan if you're an employer that had not previously had one, and this is more directed towards that SEP and Simple, so plans dedicated towards small business owners. But there's maybe a little bit of a balancing act that the solo 401k plan, the ability to have a 401k wrapper as a small business plan, has really created a lot of opportunity for folks that maybe want that from either a present to employees. Yes, we do have a 401k plan down the road. As an individual employer, that would be limited to you and your spouse. But if you're establishing a plan for you and other employees, that SEP and Simple are very low cost. There is a credit that is established for doing so, and can keep costs down pretty significantly. So, for those that haven't yet done so, there is a enhanced opportunity.
And more good news. And I think it maybe as a sidebar and a little bit of a commercial. I mean, I think what we're seeing is, in so many areas in financial services, product costs have come down. They become more transparent. There's been market pressure to come out with more competitive products. And one that I think is really, we're seeing that is, without necessarily trying that much, is small business retirement plans. Seeing a lot of legacy type 401k plans that were established at some point, and the expenses are fairly high. The investment selection is not necessarily something we're all that excited about. And the company and the employees are not really getting much in the way of advice or consultation in terms of investment strategy, thinking about retirement, how to really use that tool. And so I think it is a good time to review plans that are in place for small businesses and say, hey, maybe there's a better option out there at this point. In many cases, we're seeing that. So, you have any more thoughts on that, Kevin? Or
well, I was just going to say, as it applies to that SEP and Simple piece, those are often the let's get something started plan. It's an offering to employees to know that they've got the ability to defer some of their income, but as the business takes off, in particular, kind of circling back to that 401k piece, we do see a lot of these plans ultimately migrate towards that 401k wrapper, be that a profit sharing contribution, or perhaps even layered on top of that, the ability to do a cash balance pension sort of arrangement there. And that, I know you've done some of the previous webinars focusing on that. So this is really focused on trying to provide small business owners wanting to establish a plan, wanting to provide a benefit to their employees, some relief from a tax standpoint to make those contributions, that employer contribution on their employees' behalf, and get a little bit of a tax break.
Mm-hmm. Yep. Very good. So there's maybe a few other pieces in the Secure 2.0 that have captured some headlines and generated interest, and I think they're interesting, and they're certainly another arrow in the quiver, so to speak, but maybe you've gotten overbilled a bit. And I think, Derek, you're going to give us a rundown. Probably the one that's caught, I think, maybe the most headlines, is this idea that unused 529 plan balances can be rolled into a Roth IRA. What's that all about, and what's the deal?
Yeah, bear with me, because this is a little bit of a longer section. It's definitely been,
I'm glad you're covering this one, not me.
Yeah, right. It's definitely been probably the most covered piece of the legislation, I would say, from all the materials that we were kind of, reading through, preparing for this webinar. And, ultimately, this is a nice option for those that have slightly overfunded their 529 plans. I've been with Cahill for a shorter amount of time than Kevin or Scott has, but, typically when we're planning for clients and educational dollars down the road for children, grandchildren, et cetera, we were always very careful about not really wanting to overfund 529 plans, maybe putting some money into, a brokerage or taxable account if any costs kind of rose above, because we didn't want to overfund the 529 plan, because tax treatment prior to this new change, essentially, if you had remaining 529 balances, no one to use the funds on. If you wanted to take money out of the plan, you'd have to pay taxes at your marginal rate plus a penalty on the earnings. So now with the new legislation, you can roll over some of those balances directly into a Roth IRA for the beneficiary of the 529 plan. Now, this does come with certain limitations, caveats, which I do want to run through quickly. The first is the 529 plan must be at least 15 years old with the same named beneficiary during that period. The second limitation is that the amount that is going to be rolled over must have been in the account for at least 5 years prior to the rollover occurring. The third, kind of an obvious one, but the Roth account must be in the name of the 529 beneficiary. They can't be different. The fourth is that rollover contributions with this new legislation are subject to the normal annual contribution limits. So for 2023, the limit into an IRA or a Roth IRA is $6,500. Those would have to be reduced by any traditional or Roth IRA contributions made by the beneficiary in that same year. So that's kind of an important piece too. And then last but not least, rollovers are limited to a maximum of $35,000 per beneficiary over their lifetime. So again, some limitations with that. And then a couple more items to note. There are the income limitations, I guess, for regular Roth IRA contributions do not apply to these 529 Roth rollovers. So in other words, from what we've seen so far, it appears as if the beneficiary is making over the traditional kind of income phase out Roth limit. From an income standpoint, you will still be able to roll over money into their Roth account. And then one other caveat too, keep in mind that the beneficiary does still need to have earned income to qualify for the rollover.
Mm-hmm.
So again, I think ultimately this is a nice piece of legislation for those that have overfunded 529 accounts. One thing we've read about and we've kind of been talking a little bit about, can we utilize this in any way? And maybe perhaps, for higher net worth families, this technique could be an interesting way to quote unquote prime the pump for children, grandchildren, and other loved ones down the road. But again, we'll want to be thoughtful about implementing something like that.
Yeah, it's interesting, and you've hit it right on the head. 529 plans have been around for quite a while, very appealing, the ability to invest for qualified higher education costs. And if it's used specifically for those purposes, the gains can come out tax-free and enjoy tax-deferred growth on the way up. But we were cautious. And this is another area, I think, like the Roth conversion, where many times we talk to people and say, okay, we like this, but we want to be careful because we're concerned about overfunding these plans. And they were more restrictive and more limited in terms of how those dollars could be pulled out, 10, 15 years ago. We have a meeting set up with a client in a week. And I remember when she was, a little girl and we're just starting this, and now she's out in the working world. And so it was a concern, if we had excess dollars built up in these plans, they would go from tax-free growth, which sounds great, to taxable as ordinary income on the gains and a 10% penalty, very punitive. So this ability you're talking about here, Derek, to pull some dollars out or to transfer them from a 529 plan to a Roth IRA is very interesting. I mean, one of the things that's really interesting is these types of tax deferred transfers had always just been within retirement accounts, kind of insulated in the retirement account community. So this is interesting new bridge coming from a education savings type tool into the Roth IRA. But it's also something I think we don't want to get too excited about, because there's a lot of rules that are kind of guarding this from being used as a large tax shelter transfer. I think initially saw some headlines or some comments, some excitement that is this the new backdoor Roth IRA or IRA? Could you really overfund a 529 plan? I've heard the concept of dynasty 529 plans, just park a lot of money in there because they're a tax shelter and they're out of the estate, and they allow for this bunched 5-year gifting up front. So there's some interesting things, but it may still be tricky to actually get much of the money out of there with that 15-year rule. One of the things, and so this may be a simple question, but I haven't seen a definitive answer. Maybe you have. So are they specifically saying 15 years in the account with the same custodian, or if you do a transfer from ABC company to XYZ company, but it's the same account, does that count in the 15-year clock?
I believe that it would count if you're transferring, custodians of the 529 plan. One kind of piece that I read that there hasn't been clarification on, when this came out, it seemed like a big deal, but still a lot of unanswered questions. But in the sense where maybe you have kind of one 529 plan, you've done the $35,000 to the one beneficiary. Can that beneficiary be changed at the 529 plan level? And then can you start doing these 529 to Roth rollovers with a new beneficiary? From what I've read, it appears that that's going to be okay. But again, caveat, there's no IRS rulings around this quite yet. So we'll have to see how that plays out.
Yeah. Kevin, seems like you had something to offer there.
Oh, well, I think it's a really, really important point, and it is something that we don't have clarification on as of yet. And this is not an uncommon circumstance. When new legislation comes out, there will be points of clarification. In fact, when this got drafted and released, there were several errors in it that have since been addressed. But I do think that as we consider either operational efficiency for a family, and do you need, if you've got several children, do you need an account for everybody, or could you have a sense of how you want to help with college education, and that could all live in one account where then the beneficiary can be switched even intra-year to be able to distribute funds. But some of those previous techniques from an operational efficiency standpoint may be called into question, and that perhaps now maybe there is some advantage to having dedicated, siloed off, unique accounts for each and every potential beneficiary. So things that we're considering behind the scenes.
Right. And I think, we just did a big analysis last year on 529 plan options nationwide. We had a preferred route that we had offered to people, and we liked it. We thought it was good investment options, low cost, had been using it for a long time, and did a real thorough review looking at ratings with investment options. And because, you don't have to use the plan for your state. There may be a state tax advantage in some cases to doing that, but in general, you don't have to. And we found a new plan that we say, hey, we think we like this one a little bit better because it has some of our A-list holdings, has the ability for us to actually build a model portfolio in there. It allows for a cleaner data feed, which is something that's helpful on our end in terms of working with an entire household. But we now have some questions I think we need to look at a little bit more seriously. We're saying, does it make sense to really transfer this plan? And like your point, Kevin, I think, we have some families we're working with now where maybe there were multiple plans, or what we see oftentimes is maybe it's a different family member. Maybe it's a parent or grandparent or aunt or uncle or someone who's established this plan, and there's some money there. And so there's the long range planning. And then there's kind of the game time on the field decisions of, okay, tuition bill is due, where are we going to pull the money from? And it gets really interesting as you start getting down lower with the 529 plan amounts, where we may have some visibility now, or I think we might be in college, and I could see a situation where it might make sense to say, well, let's leave that little bit of money in the in the 529 plan, with the idea that that's going to go into a Roth IRA and use other funds to pay that final amount of college. Yeah.
Absolutely. Yeah.
Okay, interesting stuff. So there's one other one that we wanted to touch on that is something we've talked about with quite a few of our clients and comes up. It's I think of interest to affluent households, and that is this qualified charitable distribution. So we have many people who are interested in giving some money, helping causes that are close to their heart, and we often talk about donating appreciated securities and donating them to a donor advised fund. That's a strategy that we like a lot. In fact, I think we're often telling people, whoa, put away the checkbook, right? That's probably our last option in most cases for making a charitable gift. Let's look at your balance sheet and decide if there's securities that have gone up in value that we could donate from, or relatively new, this qualified charitable distribution. Does anyone remember when that came out exactly? Was that 2017?
I think so.
Bill? Yeah. So that allows for dollars to go directly from IRA, or what's a 401k balance, to charitable organization. But there are some rules. It had a $100,000 limit. It could meet the required minimum distribution, which was really appealing in some of those cases. And with the Secure 2.0 raising the required minimum distribution age to 72, this created some confusion. There's also confusion initially. I think it was a 1-year deal on the qualified charitable distribution. Yep. And it got extended, and now it seems like, yes, it's here to stay. So something to be mindful of is there is a split. The qualified charitable distribution started at age 70 and a half, still has that quirky 70 and a half instead of age 72. They're now going to index that amount so you can give more away. That's part of Secure 2.0. So that's of interest. And the other big thing is that you can do a $50,000 one-time gift as a qualified charitable distribution to fund a split interest gift. Split interest gift is a legal term for estate planning type strategies where you are making a gift to a charitable organization and they're receiving some benefit and you are retaining some benefit. So there's sort of a slew of these types of arrangements that are out there, several under the charitable trust design. And then there's what's called a charitable gift annuity. But this is kind of like Derek's 529 rollover to a Roth IRA. When you start digging into the details, it sounds really good up front, but then it seems fairly restrictive, and you wonder how often this would actually be put into use. So to establish a charitable trust is going to require working with an attorney, and they're going to want to get paid, rightly so. And it's a fairly complex matter, so it's a usually pretty large bill. And so to have $50,000, that just doesn't seem to make sense usually when you look at the legal fees involved in the charitable trust. The other option, the charitable gift annuity, is sort of a forgotten tool that I think is kind of interesting. There's been, I'm sure, Kevin, you probably name some off or think of, there's been a number of academic looks at the value of having secured income in retirement, some level of pension stream, Social Security, or annuitized dollars. Traditionally, we've been pretty skeptical of using annuities as a wealth accumulation vehicle because of the extra cost and potential for having dollars be taxed as ordinary income. But I think we'd all probably agree that they serve a very valuable role potentially in terms of essentially buying a pension, putting some money into an annuity and having a guaranteed stream of income can be appealing. So this charitable gift annuity, you could pick your alma mater, Kevin, if you wanted to give $50,000 to Gustavus Adolphus, right?
Shout out to Gustavus.
Yep.
You could do this qualified charitable distribution to a charitable gift annuity with the idea that this is a device that is going to pay you some income through your retirement years. Yep. And at your demise, when you go to the great swimming hall of fame in the sky, the remainder stays with Gustavus Adolphus, right?
Yep.
So it's appealing, it's neat, but I think there again, when we run the numbers, what we know about this is that the amount that's going to come back to the donor on a $50,000 charitable gift annuity is is going to be fairly modest. But I think this is potentially a strategy that could slot in nicely for, what you might call affluent people who've saved a nice amount, but it's probably going to look like a drop in the bucket for the, real high net worth type families who are interested in doing large amounts. But for most people, the broad slice of America, I mean, doing a $50,000 gift is tremendous and would be very significant. So I don't know, any thoughts, guys, on that wrinkle in the Secure 2.0?
Well, Scott, I think you nailed it. That CRT, that charitable remainder trust, it can be extremely powerful for the right situation, but there are extraneous costs, the legal piece, not necessarily just up front, but on an ongoing basis. And so that may not be all that utilized through this plan, but the charitable remainder, the charitable annuity piece, that is really interesting. And oftentimes, and so, I've looked at this through some of the literature for either clients or even what Gustavus sends me from time to time. The rates are usually pretty attractive.
Mm-hmm.
The challenge, though, is while this could feel like a good idea, it's an ability to give dollars to an organization you care a lot about. There's no guarantee that default risk isn't high. And, so not to pick on private institutions from an educational standpoint, but there's the possibility that if endowments were to fall, if, enrollment decreased, can they still satisfy that obligation that looked like at a headline level, a pretty attractive rate of return. And so, I think if there's the opportunity, we'll work to, talk that through, but we do need to be careful about what might look really appealing and what lives below the surface as the reality of default risk, interest rate risk, complexity, all of those pieces.
Great point. So we were just having a big conversation yesterday, and I think thinking about how we look at someone's situation, trying to identify the amount of dollars that are needed as a core capital amount to support their financial independence through retirement. And if they're above that amount, if there's what appears to be a surplus capital amount,
Mm-hmm.
That's an area that we might be more comfortable saying, okay, you could gift these dollars away. You could potentially invest in something that might, to us, feel more speculative or risky, a private investment or something along those lines. And I think this is one where we would not want, without a lot of analysis, that charitable gift annuity income stream to be counted on for a significant portion of the retirement income because of those types of risk. This would be something that'd be in the icing on the cake category, saying, it appears that you probably have IRA dollars that would be legacy funds anyway. And maybe Gustavus is calling and they're doing a fundraiser, or in Derek's case, St. Thomas, or Habitat for Humanity, or some of the other organizations that you might be really close to. You can say, yeah, they would probably love to have a $50,000 pledge. However, what they're really going to be looking at is what is the expected remainder interest on that gift. But I think it's an interesting piece there that I could see falling in for several people's plans, but probably not one that we'd want to count on as really that high probability diversified stream of income that we'd be relying on to pay the rent and buy the food and stuff. So, well, any other general thoughts? I think those were some of the big themes, as we leaf through and thought, what are some of the major issues that apply to households and that people should be aware of? I think as we're working through this and studying the other 90 some provisions in this, we may reconvene for another update on either specific topics, but anything else, either specific or big picture, you guys think be worth mentioning?
No, not necessarily on my end. There are definitely some provisions that affect maybe some of our younger clients, with regard to employers now being able to match 401k, 403b contributions in Roth dollars. That's kind of interesting. There's some student loan repayment help now as well that employers would be able to do on behalf of their employees, which is kind of interesting. So there's just a few other, kind of nuggets like that I think, if you have any specific questions, please reach out to us. We're happy to talk through some of those details with you.
Mhm.
Yeah. Maybe the only thing I'd add in is not something that changed, but something that didn't change. And we've alluded to it maybe 2 or 3 times here, but that Roth conversion piece,
Yeah.
that has been potentially in the crosshairs of legislation to do away with. Initially there were income thresholds, those thresholds went away. This is for the right circumstance an exceptionally powerful tool, primarily from a multi-generational legacy planning standpoint, but it can also affect people that may not fall into that category. But the fact that didn't get targeted, that it was not omitted or eliminated from this new batch of legislation. So to Scott's earliest point, that Roth piece seems to be getting additional encouragement. And so for people that are willing, and these are, Scott, Derek, these are not always easy conversations to talk to a client to say, hey, let's voluntarily pull some tax forward. You're going to make a decision to pay tax. Usually we want to avoid it, but the fact that still lives out there as a tool that we can leverage for people is a big deal.
Right. Yeah, absolutely. The Roth conversion, the backdoor Roth IRA, it was also, related strategy. It was not that long ago. I think I want to say 5 years ago, there was still, you could look at some nationally recognized commentators, and there's a difference of opinion of, can you put money in it and immediately do this backdoor Roth IRA maneuver, or do you need to let it, be seasoned and sitting there for a year? And it was not clear. And I think there was a lot of thought. I remember thinking, like, is this a valid strategy? Is this cleared out? Is this a gray area? And this is clearly a time when this could have been addressed and quashed and shut down, and it hasn't been. And it's now one of the most hyped up strategies. Every personal finance blogger out there is talking about backdoor Roth IRA. So it's not like it's a secret or an unknown strategy at this point, and it's still alive. So yeah. Well, thank you guys. This is great, and thank you for joining us, those who are on, or if you're listening to a recording later. And like I say, just to reiterate, general discussion, there's a lot of detail there. Feel free to shoot us an email, give us a call at the office, or consult with your own tax, state, legal advisors, and see how these things apply to you. But thanks all, and we'll be back soon with another exciting wealth strategy session, I'm sure. So take care.
Bye-bye.
Thank you. Take care.